Deciding which bond to choose can be time-consuming. Which bond should I invest in and why? But there is a difference between buying a bond and having a strategy for it. A bond strategy is what happens before and after the purchase. How do you decide what fits your investment goals and how you structure your holdings over time? That's what this video is about. The information in this video is for informational purposes only and does not constitute investment advice. Always do your own research or consult a financial advisor before making investment decisions. Bond strategies differ mainly in how actively you manage your maturity, interest rate exposure, and reinvestment decisions. There are three commonly used approaches worth understanding. Let's dive into the first one. Buy and hold is typically the most hands-off approach. You purchase a bond and hold it until maturity, collecting coupon payments along the way and receiving your principal back at the end. The main advantage is predictability. If the issuer meets its obligations, you have a clearer picture up front of what you might receive and when. Price fluctuations in the secondary market are less likely to affect you because you intend to hold the bond until maturity. This makes it more attractive to investors who prioritize income stability, have a defined time horizon, and don't need frequent access to their capital. The second strategy is laddering. Laddering is considered a more structured approach to the timing problem. Instead of buying one bond at one maturity, you spread your capital across bonds with staggered maturities. As each bond matures, you reinvest the principal at prevailing rates. This solves two things at once. First, it reduces the need to predict where interest rates are going. If rates rise, your maturing bonds can get reinvested at better yields. If rates fall, the longer dated bonds in your ladder can still earn the old higher rates. Second, you have scheduled liquidity intervals. Cash returning to you periodically rather than having everything locked up until a single distant date. The trade-off of this strategy? Laddering is conservative by design. It reduces interest rate risk, but it doesn't maximize the return potential in any single environment. It's a strategy built for consistency rather than optimization. Let's talk about duration positioning, the third strategy. Duration positioning is usually the more active approach. Here, you intentionally adjust the average maturity and therefore price sensitivity of your bond holdings based on where you expect interest rates to go. If you expect rates to fall, extending into longer duration bonds could be a good decision. Prices on longer bonds usually rise more sharply when rates decline, so you can capture both the coupon income and the price appreciation effect. If you expect rates to rise, shortening duration reduces your exposure to potentially price declines. You are holding bonds that mature sooner, so you can reinvest at any new higher yield bonds faster. The caveat here, this strategy only works if your rate forecast is right. Predicting central bank policy and the timing of rate cycles is generally difficult. Even professional fund managers get it wrong regularly. Duration positioning can add return for investors with informed views, but it also adds risk. How to evaluate your bond performance? Across all three strategies, the same evaluation mistake comes up. Using the coupon rate as the primary measure of return. The coupon tells you the annual interest rate payment relative to the face value. What it doesn't tell you is what you will earn given the price you paid. For that, you need yield to maturity. Yield to maturity accounts for the coupon, the purchase price, the time to maturity, and the principal repayment, all in one figure. Two bonds with identical coupons can have very different yield to maturity, depending on what you paid for them. Using yield to maturity can help make more informed decisions when comparing bonds. If you buy a bond below its face value in the secondary market, your yield to maturity will be higher than the coupon, because you will also gain the difference at maturity. Buy it above face value and your yield to maturity drops below the coupon. Same bond, same coupon, different return depending on what you paid. The second thing to evaluate is credit quality. The standard tool for this is the issuer's credit rating. Rating agencies like Moody's, S&P, and Fitch assess the financial health of bond issuers and assign a letter grade. Investment-graded bonds, broadly those rated BBB or above, carry lower default risk and typically offer lower yields in return. High-yield bonds, also referred to as sub-investment-grade bonds, are rated below BBB. They offer higher yields to compensate for the increased risk that the issuer might not repay. Let's also look at the duration as an evaluation metric. Duration measures how sensitive a bond's price is to changes in the interest rates. The higher it is, the more the price moves when rates shift. When you are assessing a bond, knowing its duration tells you how much rate risk you are taking on before you commit. Two bonds with similar yields can have different durations, which means very different risk profiles. Finally, consider liquidity. Government bonds and bonds of larger, well-known issuers tend to be actively traded in the secondary market, meaning you can usually sell relatively easy if your plans change. Corporate bonds, particularly from smaller issuers, can be much less liquid, and selling at a fair price isn't always straightforward. Let's recap bond strategies. Buy and hold works if you want simplicity and income stability over a defined period. Laddering manages rate risk without requiring you to predict the future. Duration positioning can add return if your rate view is correct, but it adds risk if it isn't. The key is deciding what role bonds are playing in your portfolio: stability, income, or both, and letting that drive your decision. If you're ready to explore bonds yourself, Mintos offers high-yield bonds from just €50. You can automate with the high-yield bonds portfolio or select individual bonds and exit early through the secondary market if needed. If this video helped you understand bond strategies better, give it a like. And if you're ready to start building a portfolio that includes bonds, check out Mintos and see what fits your goals. Thanks for watching. Here's to smarter and more confident investing.